Adjustable rate mortgages are back, and you guys may remember adjustable rate mortgages from the 2008-2009 housing crash, as they did play a part in it. But the question is, are the adjustable rate mortgages that people are taking out today contributing to another potential market meltdown? That's what we're going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And a few interesting articles came out recently that really have piqued my interest in the housing market, because now it's looking like more and more people are utilizing adjustable rate mortgages to enter into home purchases in the US. So the first question I had was, is this going to be increasing the risk in the housing market the same way that it did in the housing market collapse, or leading up to the housing market collapse in 2008 and 2009? And so let's dive right into that. So if you can see here, adjustable rate mortgages are back, but the Wall Street Journal reports that it's not like you remember. Those ultra low teaser rates and lax lending requirements are gone. So right off the bat, these are not the ARMs that we had during the real estate crisis, but do they add risk to the current real estate market that's already hot? And so that's really the question that I'm battling with. And the next part of the article does dissect that. So you can see here that although applications for adjustable rate mortgages have doubled, they're still a really small fraction of the overall market. So 9% of the overall mortgage application market. So it's not that big at the moment. However, you could see this ticking upwards as interest rates continue to go higher, or as home prices continue to go higher. And it seems like it's stronger, more financially savvy borrowers that are using adjustable rate mortgages. So you can see that the article goes on to say that the type of borrower that's qualifying for these ARMs today is significantly different from the borrower profile that we saw back in 2006 to 2008. The customers that are getting these adjustable rate mortgages have a credit score of approximately 750, compared with the average credit score of 730 for applicants approved for 30-year mortgages. And that makes a lot of sense, because in Canada here, we also have ARMs, and that's something that I've utilized for many, many years, as I like the interest rate differential between an ARM and a fixed rate mortgage. And so I've saved tons of money. I think I probably saved over $150,000 in interest costs by utilizing ARMs here in Canada when I've purchased my own home. And you can see here that ARMs right now only make up approximately 2.1% of the mortgage market. 11.3% of the overall market is 15-year fixed mortgages. And of course, you can see that the significant majority of the market, 81%, is people that use 30-year fixed mortgages. So overall, it's not a substantial portion of the market that's utilizing ARMs. But what's interesting about this chart is that you can see that in 2005, the adjustable rate mortgage amount went up to around 50% of the mortgages in the US. So you can see how this type of mortgage was really used, and I would say abused, which led to the housing market collapse. But by around 2010, you can see that adjustable rate mortgages as a percentage of the market declined to historic lows. And it kind of stayed there, except for now, where they're starting to tick upwards again, only slightly though. And I know that there's a lot of younger people that do view this channel, and it's crazy how much time has passed already, because it feels like the mortgage crisis was just yesterday. But just as a reminder, you can see here, it wasn't just adjustable rate mortgages that were to blame completely for the mortgage crisis. It was a combination of adjustable rate mortgages coupled with very, very loose lending requirements or lending guidelines, i.e. liar loans with zero income verification, which is what caused the mortgage collapse. People just got mortgages who should not have been able to get mortgages, or in many cases, there's people that got mortgages for 5 homes that shouldn't have even gotten a mortgage for 1 home. Lenders enticed borrowers with exceptionally low introductory rates that significantly reduced mortgage payments at first, allowing homebuyers to stretch their budgets. And then, of course, when the loans later reset, many borrowers were unable to afford the higher payments and were forced to sell. That, of course, caused a lot of inventory to come onto the market, and naturally, you know what's going to happen when that happens. Home prices went way south as a result. A lot of people were underwater on their mortgages. It was a really tough time in the States. And since then, ARMs have been cleaned up. There are no more short-term teaser rates, And you can't penalize people for paying off their arms early, which was something that was being done historically. And as you can see here, borrowers who apply for arms today must be able to afford monthly payments significantly above their initial rate. So in other words, the banks are essentially doing a stress test on these mortgages at the individual borrower level to make sure that their income suffices as the interest rates go up. So that's a very interesting new development. And it looks like these days banks tend to keep adjustable rate mortgages on their books. In the years before the financial crisis, they were often packaged up and sold to investors. So this is another reason why you need a higher credit score before a bank is willing to give you an ARM. But it's also another reason why banks are discouraging people from taking out ARMs, which is why it's only around 2% of the overall market. Now, here's why I'm such a huge fan of ARMs, and I already mentioned it earlier. You could potentially save up to 200 basis points off the fixed rate based on the numbers that they've given you here. So overall, I don't think adjustable rate mortgages are increasing risks that are already inherent in the housing market. And the one thing that I wanted to share with you guys is, if you see here, 3 of the top 15 opportunities currently right now that exist in the market are with home builders. You can see Dreamfinders Homes, TriPoint Homes, and LGI Homes. All of these I've covered on the channel before. So you can see that there are potential opportunities in the housing market with home builders. And in a subsequent video, I'm going to go over the risks associated with investing in home builders today. And so in order for you to not miss out on that video, please take a moment right now and subscribe to this channel so that you don't miss out on that video. Also, if you guys want access to the tracker that the Patreons get access to, which is where I showed you those home builders that are cheap, you can get access to that at the lower tier of the Patreon. And the other thing that I want you guys to be aware of is Ant Group and Alibaba are now separating completely, which is lending a little bit more credence to the fact that Ant Group might actually be moving towards that IPO sooner than we think. And I actually covered that in a video, which you can get to right here.